Hi, guys. Welcome to the How I Raise It podcast, the show where we get an inside, unfiltered look at how real startups and VCs raise capital for their businesses. I'm your host, Nathan Beckard, and today's episode is with Samir Kaji of Allocate, a startup that enables wealth advisors and family offices to invest in venture funds. In this episode, we go deep into what it takes to raise capital as an emerging manager from LPs. Samir shares an awesome 8-step playbook for emerging managers, definitely worth a listen. If you're tuning into this podcast, learn how to raise capital for your business, definitely check out Fundingstack. Fundingstack is the new platform from the makers of Foundersuite, which has helped companies raise over $15 billion. Fundingstack's database contains over 15,000 LPs, including several thousand family offices, wealth management firms, fund of funds, foundations, trusts, endowments, high net worth investors, celebrity investors, and so much more. It also includes a CRM for managing your pipeline, a virtual data room, pitch deck hosting, investor updates, email tools. The list goes on, and it's very affordably priced at $250. Check it out at fundingstack.com. Last but not least, if you enjoy this conversation and think someone else would too, please share it with them and hit that subscribe button to get all our latest episodes. Thank you. Now sit back and enjoy this chat with Samir.
Welcome to How I Raised It, the podcast that goes behind the scenes with entrepreneurs who've raised capital. We uncover the tips, tricks, and techniques they use to get investors to write a check. Strap in and turn it up.
Hi, welcome to another episode of How I Raised It, produced by Foundersuite and Fundingstack. Today I have Samir Kaji of Allocate coming to us from Menlo Park. How's your day going?
It's great. Thanks for having me on.
Likewise. Thanks for coming on the show. Let's get to it. What is Allocate?
So Allocate is a private markets company that makes it easier for any investor to be able to responsibly invest in the venture capital ecosystem. So founded 2.5 years ago, really with this eye of, leveling the playing field for non-institutional investors. My background, 22 years in banking in the venture industry, starting in 99 at Silicon Valley Bank, spent about 13 years there. Then I left to join another bank. Of course, everyone's heard of these banks now, First Republic Bank in 2012, where I was on the venture side. But I also got a glimpse into the high net worth market. So we had a wealth management group. That wealth management group, over time, it was very clear that the movement into alternative assets, so think about alternatives as private equity, venture capital, was becoming a staple of high net worth investors. But what we found over time was the infrastructure just wasn't there to support the average high net worth investor. So what Allocate does is removes those barriers, starting with the asset category of venture capital by bringing transparency, accessibility, and a way for people to now participate responsibly in an asset class that historically has been reserved for institutional investors.
So you got it. So you're kind of democratizing VC, if I'm putting words in your mouth a little bit, but it's not for it's for like family offices and accredited investors, right? You're not targeting the grandmas and average folks and helping them get into VC, are you?
It is for accredited investors that, number one, have the ability to weather some of the liquidity, right? So venture is a long-term illiquid asset class. Our view is not everybody should do venture capital, but, people that are in the accredited or higher, bucket, a small portion of their overall net worth typically is reserved for private investing, which historically has provided the best returns when juxtaposing it across fixed income, traditional fixed income, and public equities.
Yeah. Okay. Let's take a simple use case. So let's say I have the Nathan family office and kind of maybe a before and after scenario. What am I doing today to get into VC, and what am I doing, when I find you guys?
Okay, I'm going to add a little bit to your scenario. So let's say Nathan, family office is located in Texas, oil and gas background, is looking to diversify their assets away from just, things like traditional public equities, fixed income, maybe oil and gas and real estate. And there's a sleeve that you want to open up for things like private equity and venture capital. Today, your avenue to do that would require a lot of time. So time to go out and find managers, do market mapping, canvas the universe for some of the most successful managers out there. You would have to then come up with portfolio construction of how much am I going to invest every single year? What does that do to my cash flow? How does that relate to my correlation to the rest of my assets? And by the way, I still have to spend the time to diligence managers and then somehow gain access into the most interesting managers on terms that make sense for me. When I say terms, check size that I want to write without sacrificing diversification, being able to get into the managers that I want to versus being relegated to not getting into the top, so therefore getting into maybe the second or third tier set of managers out there, which don't really provide you the lift when it comes to the premium on liquidity and illiquidity and risk. And then after you invest, well, you have to track all your investments in a single place, hopefully. Right now, as a family office, if you make 20 private investments, you may be logging into 7, 8, 9 different fund admin portals, pulling down PDFs, putting them in a single repository, and then trying to extract information from those PDFs to understand how your portfolio is actually doing so that you understand how you're tracking toward your objectives and goals. So we, through technology, simplify the entire process from market mapping to personalizing the experience for you. So you see opportunities that fit your objectives. And then after you invest, having a single pane of glass to be able to track all your private investments.
Yeah, cool. I guess on the question of access, this always seems like one of the big ones, I'm sure, of, if I'm Nathan Family Office, you've never heard of me, but I've made some money in wildcatting in Texas, to continue with this story. I guess, why would a top venture fund let me in, right? Because they're already often oversubscribed. They have more LPs than they can possibly deal with. So how could I get into the good stuff? And I guess, or we could even ask this a different way. How do you attract the best funds, not the bottom of the barrel, who need LPs? Yeah,
it's such a great question. And it goes back to, how do you also make it easy for the manager? So typically, you're right, a manager who's raising, I don't know, $750 million that has had a long track record. If you look at their LP base, predominantly it's going to be institutional investors, foundations, endowments, maybe pension funds in there. And ultimately, they gravitate toward those type of LPs primarily because they're long-term sticky capital run by people that understand private markets, can have a long-term lens. So if Nathan Family Office knocks on, the door of, let's call it Sand Hill Road X, and says, hey, I got $500,000 to invest in your fund, where do I sign up? The answer is probably going to be no. Now, the way we make it easier for the managers is we typically set up a vehicle for the manager that aggregates the capital from all of the smaller investors. So on our platform, investors can invest as low as $100,000 through some of these specially created vehicles to then invest in the underlying fund. In certain cases, investors are able to go in directly, typically because they can write a check size that's large enough where it at least meets maybe a negotiated minimum that we've created with the manager. But in whole, it's the power of scale. So if Nathan Family Office is doing $1 million, we have 20 of you. Well, each one of you may only be doing $1 million, but in aggregate, we're doing 20 million to the manager. So that gives us the ability to take the non-institutional class and institutionalize it through the power of scale. So, as of today, our clients have invested a little north of $500 million really over the last 23 months into different opportunities, ranging from, first and second time funds, which are emerging manager bucket, all the way to firms that have been around for 50 years.
Interesting. I don't know if you're going to like this or not, but, people often categorize folks. You're like people come to us at Foundersuite all the time. Like, oh, you're like HubSpot for raising capital or whatever. It is a little bit like what AngelList was in the early days of sort of democratizing access to angel investors, but more for funds. Is it kind of an apt metaphor or not really?
Our demand side of the equation, being the investors who want access into this asset category, tend to be in more enterprise. So
Gotcha.
high net worth, family offices, and then registered investment advisors that act as wealth advisor firms.
Yep.
What we're really providing is both the origination and the technology. And the technology goes from everything from KYC, subscription documents, post-investment reporting and analytics to make it easy for the end investor to be able to not only get access, but to manage their investments in a way that's highly digitized. So a lot of people will compare us more likely with, folks that have been around in the private equity space, iCapital and Case. There are some, nuances that, we think are very different in terms of not only the asset class that we're going after, but also the long-term vision when it comes to technology, which is we believe in 5 years, every high net worth investor will have private assets in their portfolio. It's hard to debate that at this point, given that 87% of companies generating over 100 million in revenue are all privately held. So much value capture. And the key is to building an infrastructure stack that makes it easy both with the fund manager as well as the end investor to be able to work together. And so, those are the ones less AngelList, which, we think, very highly of what AngelList, iCapital, and Case have done. Our view is there's a version 2.0 of what the private markets look like.
Yeah. Let's take it from one other use case. I'm an emerging manager and maybe I'm raising my first time fund. Is this an appropriate place to source LPs, family offices, or others?
So it can be. So just to put a few things in perspective, though. Number one, we are not a just broad marketplace. Everything is curated. We've done 58 strategies, going on 60 once they close, of which 24 have been on Fund 1, 2, and 3. In order to keep a level of integrity in the platform of curation to the end investor, we have a full investment team that does vet every single opportunity. So going through an institutional diligence so that when an investor is on the platform, they know that, any fund on there has gone through this rigorous level of diligence, legal diligence, and it's something that we feel is a responsible type of investment for the end investor. So yes, we do. The bar is high. We look at about 700 firms every single year, of which, we will look to put maybe 40 to 60 on the platform on an annual basis. And that is our, investment part of our business, not the analytical tools and the software tools that I mentioned.
Yeah, that's interesting. Let's touch on that one more minute, because I know we will have emerging managers listening to this. So maybe if you can share criteria, you look at 700, you accept 40 to 60, somewhere around there. What's the common criteria of those 40 to 60 that get accepted?
So let's just maybe stick with emerging managers. For managers that have been around, it's a function of their track record, their brand, their competitive advantages. We view the venture market in the following way. So we think that there's many ways you can actually win in venture, meaning different sort of portfolio constructions, where you play, different sectors, different geographies. The most important thing we think is GP thesis fit, meaning that is the GP somehow advantaged with whatever strategy that they're going after? So when I think about strategy, I think about if somebody wants to go after AI, how are they uniquely positioned? Did they just wake up and say AI is the hot thing and I want to do it? Or is it somebody that might have worked within the AI sector for a long time, investing before OpenAI became commercially mainstream, and really has the networks, the domain expertise, and the brand within that sector to succeed? And are they operating out of a fund model that allows them to win consistently, right? Not too big, not too small. So we look at that. The other thing I would say more broadly about the venture industry, we think it's very much a barbell industry. So we think that if you're large and generalist, there are only a few firms that can consistently win as large generalists. I think the world of specialization is here. So if you're a seed fund, outside of the firms that have been here for a long time, maybe 15, 16, 17 years, most early stage funds need to be specialists. What you want to avoid is the murky middle, that $300 million fund, $400 million fund, where you're a generalist, where you're competing with the bigger brands that have more resources, more capital, and more to bring to founders, where it's hard to compete with them because they do invest in the seed and Series A. And you're also not advantaged against the $150 million seed fund or $100 million seed fund that has deep domain expertise in a certain area. So barbell approach, highly inclined towards specialists versus generalists, outside of the ones that are very clearly enabled to succeed even as a generalist firm. And we know some of those firms, whether it's the Sequoias of the world, the Andreessens, the Excels, that have the ability to win in that generalist, type of strategy.
Yeah. Cool. All right. One more question on that, and then we'll move on to some other stuff. But let's say I have that criteria. I've got a great track record in AI, continue with this. I've been doing this for a while. What else do I need to come with? I mean, does it help to come to your platform with half of my fund already committed, or, can I come with 10% of it committed? Is there anything else that sort of tips the favor and getting accepted?
We're not big fans of being rigid in any way of our thinking when it comes to investing. At the end of the day, funds that go on the platform are ones where we believe they have the highest probability to succeed. And so, yes, if someone comes to us with a $150 million target and it's been 6 months and they've only raised $3 million, that's going to lead to questions of viability. Because if you think that's 150 is what you need for your business model and for you to sustain as a GP team, and you've only raised 3, that's a harder from a risk standpoint. But, if someone comes to us early and they are raising 50 to 100 million and have a good line of sight to maybe, some portion of that, maybe 20, 30%, that's not going to in any way violate anything internally in terms of our rules. We don't have the rules. Again, we're looking for GPs we believe understand what it means to build a firm, not just raise a fund. Understand where they fit in. Like, what are their competitive advantages and where are they going to build a moat? And then are self-aware to understand the difficulty of this business and understand that even getting to a 3x net is very, very difficult. So again, it's a people business. We are betting on the person, and we're looking at all of the things on the periphery around, we actually don't look at track record as much as other people. Our view is track record is backward looking. When we're making an ex ante investment on a go forward basis, a lot of the past track record is often too old to matter, too new to matter, or too many things have changed. It's a directional conversation only, because if somebody's done really well, we want to know what made them do so well. And are those set of facts that made them successful maybe 3 or 4 funds ago still true today? Hard to make any assessment on a fund that was raised 2 years ago or 3 years ago, just too early in the J curve.
Yeah. One last, and then we'll move on. But let's say I get accepted. I jump through the hoops. You guys give us the green light. Do I, for my emerging manager fund or maybe first time fund, do I come on for a certain period of time? And do I have like a window to, collect interest? And actually, one more piece to that. If I get accepted, am I actively hunting and reaching out to LPs, or is it more the other way where LPs see me and can kind of choose to pursue or not?
Yeah, I mean, the beauty of the platform is once it goes on the platform, it's our advisor team and our relationship managers that are going out and talking to our clients that are on the platform. And we are providing advisory services either, on a human to human standpoint or through the technology itself, where that opportunity is then shared with clients. The GP typically doesn't have to do much at all. We don't charge GPs, so we're not a broker dealer. We are a fiduciary for the demand side of the equation, meaning our job is to bring the very best firms while making it very easy for the firms that come on our platform to be able to raise large quantums of capital, hopefully, without any friction.
Yeah, cool. Excellent. All right, let's move on to your round. So tell me how you guys have financed this.
Yeah, so I left my last organization. That was the Q1 of 2021. Of course, that was the hottest time, we've seen. And at that point, we were seeing the market inflate to a point of insanity. So we ultimately raised our first round of capital. Our first round actually was a target of $1 million. We're just like, let's just raise $1 million. This is the first time we're doing this. We don't really need a lot of capital. And then we started having conversations with people, and it took about 3 weeks to get the first $200,000, believe it or not. It was really tough. And I was kind of surprised, but I guess, like, coming from somebody that worked at a big organization, I think a lot of people were probably circumspect. Like, does this person actually want to be an entrepreneur? My dad was an entrepreneur, like, in the organization I worked with, I was an entrepreneur. So I was a little puzzled. And then we started to really understand not only the fundraising process, but our model itself. Like, what did we actually want to build? What was our big vision? And we were able to articulate a vision that was actually much larger than we originally, gave credit for. We're like, wait, maybe we're not telling the story in a way that's, large enough for venture scale. So we, as I mentioned, the first 3 weeks, a couple 100,000, and that was just friends and family. We didn't pitch to any institutional investors. And then there was an article that came out on me leaving, to start something. And then we had a lot of inbound come in. And then between week 3 and week 7, we went from 200,000 committed to about 11 million committed, to which we closed on, 4.1 million, for that round. Now, we focused less on the valuation, so we knew what the valuations were. But at the end of the day, we just wanted to work with people that understood the space, people that we had worked with in some capacity in the past, and people we just felt like would be good long-term ambassadors for the company. And so we probably took a little bit too much dilution in the seed round, but we ended up being really, really happy with the investors we got on the cap table.
Before we move on to the next round, let's unpack that week 3 to week 7 where sounds like you just got white hot. So what else was going on there? What else was a contributing factor?
Yeah, I mean, I think it was just, number one, we learned to tell the story better. I think we turned the story better. I think this was also a time where it became very clear that the alternatives market was also heating up. We had seen other companies in the area that had gotten large valuations. And, in those situations, people were starting to really focus on how do you bridge the gap between high net worth investors and the world of private investments in a more meaningful way. And so as we thought about it, we were better at telling the story. We also had a few people come in, and, momentum is everything in fundraisers. And so, we were articulating exactly, very honestly and openly and transparently with investors that we had X amount that was now building. And if they really wanted to be a partner of us, to be able to make a decision quicker. And so those were the things, which is like momentum plus storytelling. I'd say that anybody that is raising any type of capital, whether it's an emerging manager, a founder, become really good at storytelling. When I say storytelling, I do not mean telling a falsified story. I mean having a narrative in a way that's very compelling, clear, and articulate is so critical in inspiring people to see what the vision is.
You can skip this question if it's to anything, but do you kind of remember before getting white hot, how you were framing the story versus the sort of new, better version? Like, was it, anything we can share there?
Yeah, I mean, I think, originally the story was just too small. It was like, oh, we were going to do emerging managers and LPs. And it just felt like a very small vision overall. And then we're like, well, what are we actually trying to solve? What do we believe is going to be true in 5 years? The way I always look at it, we're always, as a company, you also want to build for a future you believe in, but look 5 years out. And then sort of, Mike Maples has talked about this backcast. Like, if I believe, number one, technology is going to be the biggest driver of, wealth creation and GDP. Number two, every high net worth investor will have privates in their portfolio by the end of the decade. And third, we believe that, venture is an asset class that is not only going to grow, but is going to grow in prevalence in the high net worth private sector. So we believe all of those things are true. So what needs to happen, and how do we, step stair our function and our features to be able to get to that? And so ultimately, it was like, let me tell you what I think the world's going to look like in 5 to 10 years and how we're going to be the ones to solve it.
Yeah, I like that. That's really good. Cool. You raised more money since then. Maybe talk about the next round. How'd that come together?
Yeah, so this is interesting. So at the end of 2021, we were feeling like the markets were getting too red hot. We had, raised that first round of capital in Q2 of 2021. By the end of the year, we were looking around and saying, this, I've been through 3 downturns. This market doesn't feel real.
Yeah.
Our original thought was not to raise capital until the end of 2022. And we had a discussion internally, and the discussion was centered around, well, we could wait, we can make a ton of progress, but if the market falls apart and the fundraising market changes materially, which hard not to predict that it was going to happen because gravity does come into play at every single market cycle. Well, what if we have a ton of progress and then we have to raise in a tougher environment, get a lower valuation, even though we've made a ton of progress from January to September? Why not, look at the current market cycle, which is actually very friendly for founders, knowing what we want to build. Didn't mean we were going to spend the money, but simply we were going to take on the money to help stabilize our capital base. And also, because we sell into enterprises, bolster the balance sheet. So at the end of December, we said, let's go and raise this. Let's test the waters. And in January, we kind of tested the waters. I think I had maybe about 60 conversations with prospective investors. We got a couple of term sheets that we thought were attractive. We picked one, which was led by M13, a firm based in Los Angeles and New York. And ultimately, the round came together within 60 days. We closed in March, and that was a $15.3 million round.
Yeah, awesome. Kind of a random question, but did VCs ever look at this and your pitch and like, hey, this is going to create a bunch of competing new VCs? Or, I mean, was there ever like, hey, this is going to disrupt my industry being a VC? Yeah.
No, it's probably the opposite. It was a lot of VCs looked at it and said, okay, I realize the problem. Fundraising is really tough. And one of the reasons fundraising is so inefficient is that many VCs, and this is true of private equity to a lesser degree, are reliant on one set of LPs, which are institutions. And what we saw in 22 was institutional capital dried up because of the denominator effect. They were over allocated. And if you look at the growth of the private markets, there's not a new endowment or foundation getting started every single day. So you need to tap into the non-institutional market at scale to be able to scale yourself and to create more of a wider depth of LPs that you can now onboard to raise funds more efficiently. So many of them looked at it and said, well, this is my plug-in to the high net worth market in a way that allows me to do this without friction. And I would say that this happened in the PE market. So think about iCapital Case, look at some of their funders. They were actually some of the big, the Blackstones and Apollos of the world because they saw the same thing.
Yeah, interesting. What's harder, attracting really good deals or attracting good LPs?
It's always the demand side that's harder, especially in a market that is fundamentally changed, right? So if you think about 2019, 20, and 21, we were in a world where we were in the peak area of zero interest rate policy, so much liquidity flowing around. In fact, if you look at 20 and 21, in terms of SPACs, IPOs, liquidity coming back, people had so much discretionary capital and nowhere to put it because the rates were so low. So people were flooding the market with investments into things that were what we would consider highly speculative, risk on. And we saw that in the public markets. Of course, we saw meme stocks like GameStop and others, really rise. We saw that in crypto. And then we saw that in venture where people were just investing without really thinking about the risks that they were taking on. Starting in 2022, the world changed. So everybody goes risk off. So when interest rates rise, the market goes down. There's a lot of uncertainty in the market. The investors start to pull back, which is ironic because typically, if you look historically, these are the times where you have better opportunities to invest in private markets, particularly things like venture capital. And the reason venture becomes interesting during vintages and vignettes of time like this is because you have an economic dislocation that has pushed valuations down, put sobriety back in the market where both founders and investors have to do more with less, therefore leading to better decision-making. But we're also at the inflection point within technology with a new platform with AI. Now, AI has been around for a long time, but in terms of really penetrating both consumer and enterprise in a extremely exponential way, we are at the front end of that curve. So I kind of look at, 2008, 2009 mobile cloud. In the 90s, we had a dislocation, and then we had the internet, right? So these are massive inflection points. But yes, to your question, right now, on the investor side, we're seeing things thaw a little bit, but the average high net worth investor has gone completely risk off. And when they have invested in privates, largely it's been things that are income producing, maybe private credit, given the rates have gone up.
Yeah, interesting. I guess, have you already moved or expanded into private equity, or is that sort of the future, the next wave here for you guys?
It's a great question. So our view is that the innovation economy, being tech and life sciences, a lot of value capture will happen in the private market. So when we think about, a lot of people say venture and they put everything in the venture bucket, whether it's a Co2, a Tiger, D1, or that small $5 million, seed fund. Like true venture is Series Seed, Series A, Series B at the entry point. Our view is we have done traditional early stage funds on the platform. And whether that's a crossover fund, a secondaries fund, we are looking at those type of opportunities to bring a different type of profile from a risk return standpoint to the clients that are on the platform. That said, we still do focus on technology and life sciences. Now, that could extend out to a private equity fund. It could, extend out to a credit fund, a GP staking fund. But ultimately, our true north is still focused on this secular belief that technology is going to really permeate every single company in the world. And therefore, we want our investments to reflect that.
Interesting. Cool. I know we're coming up against a hard stop here, but let me pump you for some thoughts, tips, guidance. So let's go back to the scenario of an emerging manager fund, or maybe a first-time fund. Let's just keep it simple. We're recording this in Q4 2023. The market's pretty tough right now. I talked to some fundraisers, fund managers, and they're struggling. It's taking a long time. What tips, advice, guidance, thoughts would you share for any, first-time fund managers today to help them raise?
Yeah, and when you say first-time fund managers, I kind of think about this in a couple ways. So there's actually first-time managers and there's first-time funds. So first-time fund could be a spin-out. For those, the capital markets, so long as that person had a good track record, had a good reputation, they spun out from a Lightspeed, a benchmark, an index, likely going to be able to raise their target from institutions because spin-outs have always been popular. It's the non-traditional people that haven't managed money as a fiduciary significantly in the past. Those are the vast majority of people. So the few things I would say. So number one, make sure you want to do this. If you're going to go out and do it, I think in 2019, 20, and 21, when money was easy, everybody wanted to become a VC. Now, I think a lot of people are realizing being a VC, especially at that small scale, you don't get rich, right? I mean, it's a get rich it takes a long time, right? So it's long feedback cycles. Two, it's not that glamorous. And so do you really want to be effectively a money manager? And do you want to do it for 20 or 30 years? That's the opportunity cost, because if you do it and you're raising from institutional investors, every institutional investor wants to know that you're not going to do this for fund one only, but you're going to be fund two, fund three, fund four, and so on and so forth, and you have a plan around it. So number one, make sure you do it. Ask those tough questions to yourself. Second is stay in your lane. Understand where your unique strengths are and lean into those. It doesn't matter what other people are doing or where the hot areas are. If you have a unique thesis where you're somewhat advantaged with, or significantly advantaged when it comes to sourcing, picking, winning, and helping companies, that's where you have to lean into. The third is, if you are in it for the long term, don't worry about the fund size. Some of the best firms, I mean, you think about Lux, Kleiner, lowercase, we're all initialized. We're all firms that raise less than 10 million for the first fund. So as long as you think about this similar to a company, right? So the seed round is always the smallest round typically, right? Then you raise a bigger Series A, Series B. As long as it gives you enough capital to sustain yourself, right? So you are able to, put food on the table, for yourself and for your family, and it's enough to prove out the model. More importantly, right? You can always raise a smaller fund and come back to market quicker once you have some proof points. You can also still do SPVs, although a little bit harder, for some of those follow-ons to prove that you can get access to doing follow-ons in some of the most interesting companies without being crowded out. So it's stay smaller, stay authentic, and then, really, really be brutally honest with yourself of like, do you want to do it? And if you do, what is this going to look like in 5 to 10 years?
Yeah, that's all great advice. I'm gonna stick on this just for one more minute. So let's say I've got the track record, I've got the background, I'm a first-time fund manager, but I really want to do this. I'm committed for 20 years. I'm raising a $8 million fund, nice small fund. Any other tips for cracking, obviously coming on your platform, applying and doing stuff like that, but other tips for cracking high net worth, family offices, other LP sources in this market?
Yeah. So there's a few things you can do. So number one is, you don't know until you go out and do it. So you have to build a huge top of the funnel, and there's ways to build a top of the funnel. Number one is, if you have friends and family, obviously, that are high net worth, starting with those. Do you have other contacts in the industry? Like a lot of GPs and funds that are larger will invest in emerging managers as a way to, gather deal flow and be a support check. Having some of those referenceable names can help. Many of those larger or other GPs may also unlock LPs that you should talk to. There's also things like Raise, right? So you can go to things like the Raise conference. There's so many events now that are focused on GP LP collision. So making sure you're aware of those things, getting your name out there. So a lot of things that happen organically, are through things like Twitter or LinkedIn. So, and again, it's authentic. Like, who are you? People just need to know who you are, and you may get the ability to have somebody, reach out to you. Also, LinkedIn, I know a lot of individuals that have raised funds simply by doing a lot of cold reach outs, by going through Sales Navigator, and this is not a pitch for any of these solutions, but these are ways where you can be creative in starting to get that top of the funnel. That top of the funnel ultimately will often lead to other referrals, especially when someone gets excited. If you have a family office that invests, more than likely they are connected to many family offices where often they invest together. So really getting a few of those people early by going after as much. And the thing I would say is, if you're raising an $8 billion fund and you're at 4, just get in business. Get in business, close the fund, do a first close of the fund, start doing deals. And that'll also help with the data points necessary to create a really strong narrative for the remainder of the fund.
Yeah, I like that. Any guidance for folks maybe at the beginning of this journey? They're on the diving board thinking about whether they actually want to jump into this pool.
Yeah.
About how long they should kind of plan to even get that first close. Like, is this a 3-month process, a 6-month process, a 2-year process? What are you seeing?
Yeah, to get to a first close, you probably have to think 6 to 12 months. That's for the vast majority of managers that are doing it the first time. So you have to be ready for what is going to be a very difficult raise process for most people, particularly if you don't have the networks, you don't have the access to people and relationships. So you should always think about 6 to 12 months, because most people right now, they don't have money burning a hole in their pocket to invest, right? So it's not just getting somebody to like you, but why are they going to invest in you? Because you are now competing not with only other venture funds, but other asset classes, which right now other asset classes are much more attractive than they have been. So if I think about, things like even the 3-month treasury, 3-month treasury is north of 5.5%. So it's hard to compete against a 3-month note that's 5.5% plus versus what we saw, 3 years ago, where it was 0% effectively. So you really have to understand that it's not only getting someone to like you and think you're good, but compel them to do something in light of all the opportunity costs and maybe some of the caution that investors have right now, just given what's happening in the market. Right now, we have the election coming up. We have 2 wars. We have interest rates that are unclear where they'll go. All of these things. And we have, unfortunately, the fallout from what happened in 2020 and 21 with so many down rounds and companies shutting down, which we've seen massive companies shut down over the last few weeks. So all of that are working as headwinds. But I will say that there is capital out there. There are people that believe, and I think correctly, that this time is one of the most interesting times we've seen to invest in the asset category if you can get into the right managers that have a unique theme and are uniquely positioned to succeed on it.
Yeah, I can't remember who said this quote, but it's the phrase is, buy when there's blood in the streets, right? I guess you could make the pitch where this is the ultimate time to invest in my emerging manager or my first time manager fund because I've got great deal flow. I can get killer valuations, right? I mean, kind of framing it as an opportunity.
It goes back to like, Warren Buffett of, invest when others are fearful, and then, leave when other people are greedy, which, it's harder to do than it is to say. But ultimately, you do wipe out a lot of the tourists that, weren't really there for the right reasons, both companies and funds. And so if you can weather the overall uncertainty and you're comfortable taking risks during these type of times, it could be a great, again, it's all around the asset quality though. Doesn't mean everybody's going to succeed. It's still a very tough business, which you need to be in the top quartile or top decile to really receive the type of returns that are going to justify that risk and illiquidity.
Yeah, cool. All right. I promise to let you go on time here. If people want to learn more, it's allocate.co, correct?
www.allocate.co. And also we have a Substack where a lot of what we do is education. So we are actually launching something called the Allocate Institute, which is meant simply to educate investors that are looking to access the private market. So on an average year, we will do anywhere between 40 and 50 webinars, in-person events to really get people, because we feel like investors should be fully educated on the asset class before investing. And so we do a lot of that. If you sign up, you'll be automatically on the list. Again, www.allocate.co. From there, we will, have a conversation. So thank you.
Yeah, well, thanks for coming on the show. This is really interesting, really good stuff, and pretty cool what you guys have built and are building. So maybe we'll get you on 5 years from now, or hopefully sooner than that, and see how things have evolved.
Thanks so much for having me. And